Hey everyone, we will just wait another 2 minutes. Apologies for the delay. We were figuring out some technical glitches. Hi Bernard,
Hi, Kushbu.
we can't see your video, but I can hear you all right.
Yeah, it says I'm starting you cannot start video because the host has stopped it. So
Okay, can you try now?
yeah, there we go.
Ah,
Okay, perfect.
fabulous. So how are you today morning? Friday
I'm good.
morning?
Yeah, Friday morning. Yeah, there we go.
Are you? I think it's summertime, so I'm always afraid to do anything second half of Friday. Just
Yeah, I'm already on my fourth call, so it's okay.
fair enough. Yeah. Driving out on a Friday afternoon is like not a good idea because
Exactly,
everybody's
exactly.
heading out all through summer. Thank you for joining all of us. We would like to use this opportunity to kind of bring to people what you are doing and what Rockterra is doing, and also focus on this specific property. For everyone who's joined us, Bernard is the co-founder and managing partner at Rockterra Asset Management. Um, he is, I am probably his biggest fan, but he's been managing assets in Canada and in US and is probably the only asset manager. When he shares a deal with us, I don't wait for numbers or analyses or due diligence. I know it's going to be really high quality. And if I had $1 million, I'll probably put all of the $1 million in whatever project Bernard brings in. But he has a stellar background. He's worked at BMO, investment banking, Brookfield, PwC. So he's done all of the stellar background that goes into making a rock star asset manager. Over 18 years of experience in real estate, private equity, and corporate finance. He has an MBA from Rotman. And of course, he's a CPA as well. So with that, I would let Bernard speak more about Rockterra and this specific deal in Texas, Sugarland, Texas, which is actually close to Houston, for all of those people who are still getting used to the Texas map.
Yeah,
Welcome,
yeah.
Bernard. The
Thank
floor
you
is
so
yours.
much, Kushbu, for the kind introduction. So like Kushbu said, my name is Bernard. I've been with Rockterra as a managing partner for several years. The Rockterra was formed initially to develop a strategy for investors to target value add opportunities in the United States, and more importantly, in the Sun Belt. Texas is a state for us that's a very important state. When you kind of look at the Sun Belt, we were originally targeting that strategy. You have to look at different markets. So Arizona, Texas, Florida, and Texas for us made the most sense. It's got very stable population growth. It's got very high income affordability, which I can touch on a little bit later why that's important when investing in multifamily. So basically, it's your typical value add routine that the U.S. provides. So very business friendly, landlord friendly state. So there is no rent control like you do see up in Canada or in other U.S. states. So that basically is very favorable to us when running the business model. Rockterra specifically targets it co-invests sometimes, and sometimes it goes in directly and buys assets. We try to buy assets of institutional quality, so anything over 100 units and up. And why do we do that? Simply because it allows us to hire on-site maintenance staff, leasing, property management, in order to gain scale and in order for the investment to work very nicely for investors. This particular deal, we sourced purely off market. We originally got interested in this deal in 2020. It's owned by a pure kind of mom and pop owner at the moment, and he's from out of state. So not even in the Texas area, and it's just getting old and elderly and wanting to dispose of the assets. We knew this asset is going to be very highly sought after because of simply the fact that there's not a lot of deals in Sugarland. So Sugarland is high income. Very nice suburb of Houston. It is not on the floodplain. So some people that might think, oh, Houston, there's hurricanes and there's floods. This is way out of that zone. So we don't have to worry about the risk even if there is a hurricane that comes through. So we were looking at that, and in and around a 10-mile radius of us, about 85% of all the multifamily units are owned by institutional players. And why that's important for us is not only in terms of quality, but in terms of exit. So when we purchase this asset, 2-3 years down the road, if we want to exit, one of our first calls is going to be to one of those institutional buyers. So around us is New York Life Co. For the Canadians that are in the crowd, there's Casa Depot that owns units, all in these areas, and they're all institutional players, and we would like that. So the other reason, so let me just give you a little bit of background on the property. It's a 288 unit property in Sugar Land. It is all garden style, 3-story pitched roof, built in, originally started construction in 2001. It was finished in 2004. It had an owner, which was the original developer, till 2014 is when the private owner bought it. And now he's putting it up for sale. So we were able to get in much earlier, at the very early stages, because we've asked them a few years back. So we were kind of one of the very first calls to get the deal looked at. We got it under contract. We've got Barings Bank behind us, which is very important this day and age, to solidify terms and to make sure that there's certainty of funding. Sometimes in the deal environment with interest rates going up, it poses a risk where the bank pulls the terms and issues new terms. So Barings is not doing that. I'll talk a little bit more about the financing piece of this deal, which is very, very attractive also. So it's 288 units. We plan to rehab close to about 30 or 40% of those units at the moment, and the business model could change. But we're going in there doing your typical value add. So we're putting new signage in. We're going to do the new countertops, shaker cabinet doors, rehabbing the bathrooms. For a lot of the people that saw the drone video, you can see interior, there's not a lot to do, but there are certain areas which you can kind of bring it up to the platinum level finish. Now, Sugar Land is an area where there is affordability, and it allows for people to actually pay those rents, on average being right now in Houston around $1,700 per unit.
So Bernard, before we get into more details of the property, for the benefit of our audience, could you also describe how you classify assets into core, core plus, value add, and opportunistic? And why are you specifically choosing value add in this current context of macroeconomic scenarios?
Yeah, so for the people in the crowd that are real estate investors, even when institutional players look at real estate, in that pillar, they kind of have 4 categories that they look at. The strategies are core, core plus, value add, and opportunistic, and it's almost a linear relationship between return and risk. So core is your typical strategy where we go ahead and buy an asset and we just simply sit on it and take in the income. So back in the day, the best types of core assets for institutional players were office towers. So you would buy an office tower, leases would be signed, and we would just get the type of return. Now, the return historically, say over the last 50 years or so, core is gained on a net basis, kind of 5 to 8% IRR, which is, some players might think of that's a little bit low, but it's great for pension funds, other institutional investors, because they have teachers that they have to pay out, or policemen or firemen. So it's safe for them. Guaranteed. And they like it. And that's why for this asset, we'll explain why that's a good exit strategy for us. The next one is core plus. And then the only difference between core and core plus is you might have a new leasing arrangement that you have to do, very little upside that you do, but you're not doing anything cosmetically or changing, renovating. You're not doing anything. So it's more of getting a better tenant mix, putting in a new lease, updating the lease. So doing a lot of admin and internal type of work in the core plus strategy. When you're doing that, your returns are kind of anywhere between 7 to 11%. So it is a little bit better depending on the opportunity and depending on the asset class. So whether it's office, self-storage, residential, and so on and so forth. The next type of strategy, which brings up a little bit of the risk, is value add. But the risk is incrementally in nature because of renovations. You're not, tearing structures down. You're not erecting new buildings. You're not putting in zoning applications, site plan approval applications, which sometimes within cities, depending on where, it can be burdensome and timely. And this strategy works well because it works very well when you have landlord and friendly estates, so where there is no rent control. Now, globally right now, it's difficult to find areas where there is no rent control. And United States in the Southern Belt is the best place to do this type of strategy. Now, when you say rent control, there's certain states, for example, like California, which has rent control, but it's not as strict, for example, as in Canada. So in the LA metro area, there's 8% cap. So, you have to cap it kind of at 8%. But if inflation these days is running north of 8%, you're starting to bite into the return. So that's why we like, friendly states such as Arizona, Texas, Tennessee, the Carolinas, Florida, because they do not have any sort of rent control. And if tenants stop paying, they do have friendly eviction notices, where it's kind of 30-day and very similar to what commercial real estate is, and for example, in New York and so on and so forth. So we like that strategy because we buy the asset, and on day 2 we can go ahead and start work, and we can go ahead and start rehabbing, putting in a business plan into play, and not having to ask for any political body or government organization to get approvals and so on and so forth, which kind of sometimes leaves the asset owner, to succumb to their expectations and so on and so forth. So this type of strategy is good. Historically, it's been kind of anywhere between 11 to even up to 18, 19% IRR. Now, these are net numbers, and these are what historically has been an average. So we know real estate's a cyclical game. So at times there could be better numbers. At times there could be a little bit on the lower end. But in this type of environment, we are kind of playing underwriting in the average space. And then the fourth quadrant is opportunistic, and that's simply development. Anywhere from greenfield development, where you're buying land, to up to getting it right before construction of residential units, of industrial units. So the big strategies these days for opportunistic are industrial and residential. They prefer, they give the most risk-adjusted return globally. But there are also different areas which are in need of certain residential units or industrial of that type of strategy. So those are your 4 quadrants. And the 4th quadrant, realistically, it depends really where you are in the world. It could be anywhere from 18% to as high as 40 and plus. And those 40 and plus are, if we go ahead and develop a hotel, for example, in Brazil, where a lot of risk, we don't know what's going on in terms of approval process, that type of arrangement. So we obviously take our risk very seriously, and we mitigate it wherever we can. So if we do get into that opportunistic quadrant, we do make sure that all these risks are mitigated and they're looked after. And now opportunistic, that could also be developing multifamily in those southern states such as Texas and so on and so forth. But for this specific strategy, it's a value add, stabilized income, good occupancy at this stage. And we do see that the value add here is renovating these units to a platinum level finish, which in Sugarland is not only attainable because a lot of the players in Sugarland have these types of units, but we're able to capture on that rent growth.
Got it. And like the property, to be honest, has like a fabulous resume, so to say, on every axis. Excellent location, Houston, like you said, these are high income areas, good schools, close to business parks, like you have Amazon, Audi, Schlumberger, they're all in that area.
You got it.
Population growth is high. It's not a flood zone, wasn't flooded during Harvey. So
Yeah.
clearly, like it has everything that you have about a good quality geography. So kudos for you guys on tracking this for several years before actually converting it. It also shows that you're not just buying what comes your way, but you've been like almost targeting to acquire this for several years. And that shows in the returns because I guess you guys are
Yeah.
projecting for a class B almost 17, 18%, 3%
Yeah,
annually, 2%
yeah,
cash.
16, 17% kind of your net return over the course. There is a cash on cash component
Yep.
to the 5 to 7% range over the course of the hold. We do have various exit strategies. Right now, this is a bridge deal with Bearings, so it is a 3-1-1 deal. So basically, 3-year term. We're not gonna do anything for the first 18 months because there's a prepayment penalty
Yeah.
on the deal. So, but we're not in a hurry in terms of we're in a hurry to do the value add to bring the property up to a very nice platinum level finish. We're going to assess after we do those first initial value add units to see if we go and continue on. We don't think we want to do all of the units because the good exit strategy is to leave some units on the table, not rehab, in order for the next purchaser to have some upside, and that's the best way to exit that we feel.
That's
Yeah.
that's a unique strategy that I had not thought of, but you're right. If you capture all of the upside, then the next buyer doesn't have everything to capture.
Now, it like I said, it depends really on the buyer. So if the buyer is that, New York Life Insurance, where they're okay with, a typical where they're getting that income stream, then we might say, you know what, if they're really interested in this deal, we might go ahead and rehab and get a little bit more upside. But if we think that the buyer is going to be an asset manager, typically a value add strategy, then we're going to not do all of them. So, we're going to gauge the interest of our neighbors, 6 months after acquisition. And those are through broker relationships, and we're going to gauge their interest in terms of procuring this asset right from the get-go, so we get their interest. And that's why we like the deal, because it's much easier to talk with institutionals about selling than it is to individuals, for example.
Yeah, that is fabulous. Let's talk a little bit about the returns. One of the biggest concerns people have when investing in real estate at the moment is we are heading towards recession. Seems like there's a lot of inflation pressure both in the US and in Canada. And just yesterday, we had this webinar with Nigel D'Souza from Veritas Research, who was saying that the bond markets are assuming that interest rates could go up at least up to 4%. He personally feels they may go up to 5 to 6% in Canada and similarly in the US, and it may not come down very soon if the unemployment, for example, isn't going too low. So if it isn't a catastrophic scenario, it's going to remain high. So how have you guys planned for the financing and also factored in cost increases, factored in any interest rate rises, and does it impact the numbers that you have projected, or is this all baked in?
Yeah, I mean, a lot of the stuff is already all underwritten in, and there's a lot of contingencies all throughout the model. But just to address, I think the biggest kind of risks that we saw was the interest rate environment. That was definitely a big risk. And the other one is in multifamily, you have to be careful because an occupancy, you need to have the rental income coming in. Otherwise, it becomes a difficult play. Now, housing, when you kind of look at A, B, C, and so on and so forth, in kind of recessionary type of environments, you want to be in the B higher area. And the reason is because of affordability, because the ability to retain those tenants where they have a little bit more of disposable income. So when we look at areas, for example, like Tennessee, we see that there's areas where now affordability is almost maxed out, right? So the extra amount of people that they have to pay for in an inflation environment, they're not going to have on rent. Now, rent is one of the last things that people kind of quote unquote give up. But it's food is next on the bottom of the pole, right? So when we looked at this deal for specifically for affordability, and there is a high income area demographic, great schools in the area. So, a bump of, for example, $100 to $150 to $200 a month is not going to have that much of an effect as it would, for example, on the Class C property, where people are there's less of a margin that for rental. The other risk area that we foresaw is obviously debt. So when we were financing this, we said, you know what, a lot of the deals, for example, now to kind of 4 years back have all been done on variable bridge loans. We decided about a month and a half, 2 months ago, where we're going to take the risk completely off the table. So we had an original bridge loan, which was variable, but we switched it into a fixed conversion with bearings. So we locked it in at SOFR plus 310, which basically all that translates into is a fixed rate of 5.10%. So it eliminates the risk off the table. We don't want to have that ability where we can't predict what the Federal Reserve is going to do in the next, say, a year or so. Our view is, and from the bankers we talk, is that it is going to keep going higher, but from our standpoint, it eliminates that risk, so we don't have to, succumb to various rate increases, and we have all that obviously incorporated into our financial underwriting and in our model.
Got it. Okay, that's absolutely fabulous to hear.
Yeah.
In terms of you guys' experience, I mean, I'm obviously a big fan, and a lot of institutions are a big fan of the work that you and your company do, both in Canada and in the US. Even when we brought your previous deal on the platform, which was in Ajax, over the months that we have been an investor in it, every new update makes the return go up. You don't say it, but when I am doing my math, I'm like, okay, these are all positive developments of whatever was underwritten. We know we are going to not just hit that far exceed. We started with 145 units, now it's 203. So clearly you have a great track record in Canada and in US. If you could talk to the customers a little bit about what you have achieved in the US as far as asset management, the kind of exits you've done. You worked in Texas before, so you're familiar. That would be great.
Yeah, no, absolutely. So we've acquired a few properties in Texas before, so the track record is there. We originally started in areas in Class C type of properties, little lower Bs, and then the pandemic hit, and during the course of those management of those assets, we see that in those areas, especially in difficult times, is where occupancy declines. So there's a little bit of more vacancy, there's a little bit less. But once the pandemic was over, or sort of kind of behind us, numbers returned back to normal. But what then we did is we went more aggressively on value add. So
could you also talk about what is A, B, and C, just for our audience?
Yeah. So I mean, look, A is kind of your, I best to look at, there's a lot of amenities. You've got a pool, you've got a fitness center, it's kind of, think of it as a brand new in the last, say, 5 to maybe 8 years of development. Now there's obviously A plus, A minus in that category. But we're cognizant that certain things that are marketed in the market, say, for example, as an A, are actually true B plus. So, when we use the terms A minus, B plus, we actually mean what we say. We're not, because a lot of brokers will go out in the record and say, oh, this is a B plus property. When we think about that, it's most likely going to be a B minus or maybe in the C. So it depends how people market it. For us, it's, when we say A, it's an A property.
So A is something with high-end amenities.
High-end amenities. Yeah.
High-end amenities. Everything.
Yeah.
And recently built. So what is B and then what is C? And
yeah,
where does value add fit in?
Yeah, so B is a little bit more. So always when you're comparing these levels, you also want to compare the area that you're wanting, because it could be a B area, but it could be A plus property, right? So you want to look for areas which are higher in the area, especially in value add, they're higher properties in the area than what you're actually procuring. So the area around us, it's kind of A to A plus, and we're buying an A minus B plus property in order to bring it up to a standard that people expect in that area. Because at the end of the day, when we look at properties, we do want to have the ability to, when you look at the business model, you want to experience what an actual tenant is going to experience. So from the signage to the leasing office to the ability to go in online and actually renew, their lease agreement, or for example, be able to have links to their hydro company or their energy company. So all of that stuff is going to be automated, and that's what we're also bringing. For example, we're putting in Wi-Fi all throughout the property, which is not there currently. That's a small incremental cost, but a very large bump in rental income, for example. Washers and dryers. A majority units have washers and dryers, but they're a little bit older, so we're going to change them. We're going to move them, because that is what putting in washers and dryers in all units is a must. An extra unit of cost gives you a much bump higher in rent. So your A is your typical, you're going to have washers and dryers, you're going to have the amenities, you're going to have a pool, you're going to have proper, for example, little lounges, business centers, so on and so forth. A B is a little bit less than that. So it does obviously have the units, but it has less amenities. So it might have a pool, but it might not have a business center. It might not have a gym, for example, or any of those types of amenities. And then a C class, and you want to think about it, is just simply units. So you're not having any of the amenities. It's just a unit, a leasing office, and that is it. So when you kind of think about those different levels, and obviously when you think about classes, you also have to think about years. So most C-level properties were built, 50s, 60s, 70s. Now, there could be an 80s built C. I'm not saying, it depends on the wear and tear. But it usually determines the vintage of the year when this was built.
Got it. Cool. So you guys have mitigated the risk by saying you picked up an area which is in terms of location A, but the property is B, so you have upside to move it to what the neighborhood expects.
Exactly.
And then on the financing side, how have you guys mitigated the risk?
So like as I indicated before, so Barings Bank, so we were initially we brought the deal to Barings Bank, and they were offering, and now we're looking at a June time frame, a little bit earlier than June. And we started talking with them as early as March, but they were putting in terms to us on the table, and a lot of these deals are funded via variable 311 loans. So they're what is known as bridge loans. We originally got a great rate. It was 475 all in, and we looked at the market environment to see what the Federal Reserve was doing, to what other central bankers were doing across the world. And it is a high inflationary environment. We're cognizant of that. Usually inflation numbers creep up, and central bankers are late to the party in terms of reacting. So there is a lagging effect. So our view at the moment is that we're sort of kind of in the fourth, fifth inning of this, and of the game, and there is still more increases to come. Are they going to go up a few more percentage points? We don't think so, but they are still going to go up. So we wanted to eliminate the things we can't control, and that's why we fixed in that rate to a 5.1% all in, and that gave us an ability, not only certainty of closing on the deal, but also certainty that not having to expose the income statement to higher interest costs and then eating investor return.
So just so I understand, this is not a variable rate. This is a fixed 511.
It's a fixed.
So you've chosen
a
fixed or a variable to mitigate the risk of interest rate going up way more, which is what we heard in our webinar yesterday as well, is like it is possible that it may go up by at least another 100 to 150 to almost 200 basis points in the coming year or so. So you fixed it. So now that's already baked into the returns, which means at least for the time horizon, we don't see any impact on the returns, at least from the interest rate perspective.
You got it, yeah.
Because nothing's going to change. It is already in.
Yeah. So you have to
Got it.
also, as a real estate investor, you have to look at what I think called one of your red flags is a negative leverage. So basically, what negative leverage means is a capitalization rate is going to be lower than an interest rate. That's what you have to be careful, because in that type of an environment, you're going to get into trouble where your interest costs are going to eat into your return. Now, what happens over time is as interest rates costs rise, cap rates are going to go up because pricing, which is the denominator in the equation, is going to keep going down. Like it's going to go down, right? So it's not that pricing is going to remain for high forever. These properties are going to trade at a bit of a lower expectation because in the last 2 to 3 years they've been trading at very high per unit pricing. But you have a lot of institutionals coming into the market, and we see that this is going to be for the next kind of 12 months. It's not going to be a forever phenomenon. It's just going through the cycle. So you have to be very prudent as an real estate investor to invest in stuff where you can bring a lot of value. And that's why we like this property, because there is value add to be done.
Yeah.
And it will increase the rental component, so the revenue component of this deal, while costs are not, they're not going to budget outside of your typical 2 to 3% rise. And we're going to be able to capture the rental growth that's still happening in the market. We underwrote at a very low rental growth, only 3 to 4%. Meanwhile, the market right now is in that area is around 16, 17%. So, those are extra things that we'll capture, but they're not in the underwriting at the moment. So yeah.
Basically, you were saying that what we have as a projection of the returns is not going to be negatively impacted. That's my interpretation. Not going to be negatively impacted by interest rates, but is most likely going to have significant upside. And you've chosen the most conservative scenario, which means the actual returns, if I am thinking I'm putting my money in, is likely going to be way higher than what we have put in as numbers. But
Yeah.
on that one, I do want you to speak a little bit about the exit, and you referenced this in the beginning. In terms of exit, where we are right now and how the macroeconomic scenario is playing out. And you mentioned that a lot of large institutions will be interested in getting this property. So you have one strategy of saying, okay, there's so many good institutions that we can go to in terms of both timelines and the approach that most likely you will get. I get it that as you go, you may choose one or the other based on where you get the best outcome. But what is right now looking like the most likely exit time frame and exit approach?
Yeah. So, I mean, in these types of deals, where you have sort of a 3-1-1 deal, I'm thinking what that means is you have a 3-year term, and then you have a ability to extend for 1 year and another ability to extend for 1 year. Most of these investments, the time horizons is around 5 years. In the last, say, kind of circa 3 to 4 years, people have been holding on to them for as little as 20 months and just selling them. Now we're getting into a different environment, and our first thing is we're going to reassess after 2 years in terms of where the market's at. We could be in an area where, we're going to have a little higher interest rates. The interest rates are going to come down. We're going to have, say a lot of 50 or plus units rehabbed at that time. We could have more. And then we're going to reassess on where we are in the market. So it allows us the flexibility. And so we always do this on every property. So after about, 2 years, we'll assess to where we are in the market. And then we will determine, we'll start, having those calls with those institutional investors around that area. Or would they like to acquire the property, and what their, kind of thinking is in terms of the pricing and so on and so forth. So the first one is your option is after 3 years, we could sell it free and clear to an institutional buyer or to another asset manager. The other area is after 3 years, we could say, you know what, we could extend, we could refinance, because 3 years the rates might be lower. We don't know. So that is another option where we can refinance, keep getting that income stream, rehabbing more units, and then again reassessing after a year. You do that until kind of your 4 to 5 year. I mean, if you're getting good cash on cash return and you're getting great upside into the property, and you have pinned down of who would be a good exit partner for you, you then can develop the strategy. So that's why in multifamily value add, these strategies usually work between 3 to 5 years is when you're kind of implementing your business plan, and you're determining, the asset manager determining what is the best case in terms of improving unit holder value at that time.
That was fabulous. So just so my layman version of that is, there's a likely exit evaluation point that will occur between 2 to 3 years. So at the end of
Yeah.
year 2, you will evaluate whether you would like to exit in the next 1 year. If conditions are favorable at that time, then yes, that's the first path.
Yeah, in all of our properties, we're always being proactive and asking
Okay.
our colleagues, our competitors,
Yeah.
or people that would like to buy in terms of what their value is, what they're thinking around that. And it gets them interested, it gets them percolating in terms of, oh, this is an institutional quality type asset. We'd like to have it. And you know, when an institution decides to buy it, it's much simpler process because there's no financing conditions. There's a lot of conditions that are waived basically, because there's certainty, much greater certainty of closure. So it's one of the exit points. I mean, there could be others. We could sell it to a private equity firm. There's multiple exit points.
Got it. Yeah. So, I mean, for us on the platform, we have put in a default time frame of 5 years. So we are also on our side being conservative and saying, hey, be prepared that it may be around 5 years, even though we have a secondary marketplace, so people can sell their shares before 5 years if they wanted to exit. That option is always there. But if you were looking to hold on and get the maximum returns, obviously we are stating it at 5 years. But the truth is, based on how this project is structured, it is possible that the exit happens in 3 years with the same amount of returns in IRR. And so, depending on how the macroeconomics play out, it could be sometime between 3 to 5 years, but it could very likely be at the end of 3 years, especially if we are to go by how the bond market and how the interest rates look like, which is forecast to grow for the next few quarters, but then start coming down, which means by the end of 2 years from now, we are likely going to be in a reasonably comfortable interest rate zone once again. Not
Yeah, I
crazy.
mean, for the investors in the crowd, I mean, we have to, the great thing about multifamily real estate, so that kind of the third quadrant, what I talked about, it's not as great as private equity operational businesses, but it's very similar. So you have a definite income stream that you're getting monthly. We're most likely for this one, we're going to accrue it monthly. We're going to pay it out quarterly just because, just for the sake of a lot of admin. But you're getting that income stream all throughout the hold of that asset. You don't get that in development. In development, you invest A, you'll get B back. Core and core plus, that's the only thing you're really getting. There might be a little bit of upside in the value over time, but when you tie it to inflation, it becomes a little bit lower. So this strategy, the multifamily value add strategy, historically has seen the most capital deployment from retail investors, institutional investors, investors of various kinds. That's why it's a very great asset to have, because you are getting that income drip. And I mean, look, after 2 to 3 years, you look at the investment, say, look, we're getting great cash on cash. We're getting, say, 6%, 7%. There's value already increased in terms of rehabbing the units, getting the rental increases. We'll make that determination, but that's a good problem to have at that point.
Cool. But those are all my questions. Thank you so much, Bernard. Before we end this call, I don't know if there are any questions in the audience, but are there some key highlights that you would want the investors to know before we exit and as they press the button to make their investment?
Yeah, so I mean, look, when we look at the partners in this, I can walk them through in terms of who we have as asset managers. We are the ones that are dictating, so we do have a strong team. We have an asset manager that's going to be in play. There's the construction managers. We have our own personnel in-house that does the value add in terms of coordinating, making sure the teams are going to be on there, and then keep on them that to our average is around, you can rehab anywhere between kind of 5 to say 10 units a month. But we're going to try to go, that's our strength, is we're going to try to rehab them as quickly as possible, because then it allows you to the certainty of time. You could say, after 8 months, say we rehab 50 and we have a great asset here. What should we do? And we always reassess after every couple months, what is the business plan? How are we trending? In terms of the property management, we have a very strong property manager on this deal. It's Asset Living. They manage over 160,000 units all throughout the United States, Lawson, Texas. So very great partner there. We're instituting a great technology partner, which is Gigafy, is going to put Wi-Fi all throughout the premises. New signage is going up. We have a great relationship with Whirlpool, which is going to supply all our appliances direct. That's a very special relationship, because a lot of the multifamily players out there are procuring their appliances from a third party, so call it a Lowe's or Home Depot. We are able to negotiate very good pricing, so that's not even in the financing arrangement. It's a great relationship from that standpoint, because it allows us to procure product at a much lower cost. And then we have CBRE, which is the main broker on the deal. So great assets overall, great team, and so we look forward to working and implementing our business plan.
Thanks a ton, Bernard. Yes, this is probably one of those all-star properties. Good location, underserved property, great asset managers, great partners. Now we just hope that our investors move quickly on this, because as you have told me, this is more you giving by property investors a chance to get in rather than you needing, because there are people dying to invest with you. So thank you for the opportunity to our investors.
You're very welcome.
Thank you so much for joining us.
Okay, thank you.
Thanks, everyone. Hope you guys are able to make better informed decisions on this.
Thanks, Kushbal. Thank you for your time.
Okay.